Banks, especially larger banks, always seem to try to paint themselves in a very happy-go-lucky way. Like they're lax, cool, and just a happy place to interact with and spend your money with. But the reality is, banking is a firm business. Banks overwhelmingly make a lot of money, and they have been stable, consistent assets for tons and tons of massive investors like Warren Buffett. If we go through some of the stocks that really make up the backbone of Warren Buffett's company, Berkshire Hathaway, we see a lot of things like insurance, but we also see tons and tons of bank. Bank of America is a big one, as well as other financial services like American Express. JP Morgan and Chase, of course, is there. Again, payment processors and banks. And in general, banks make a lot of money. And sometimes they do manipulative things like stock buybacks, which basically involves a company buying back its own stock to reduce the amount of floating shares in the market, sort of artificially increasing the price. The Federal Reserve actually issued a freeze on banks purchasing their own stock back, and they recently extended it till the end of the year, as well as a cap on dividends, because they really didn't want banks artificially inflating their value. They didn't want their stocks to go up in value. They didn't want the dividends to stay high when it's really a facade. And we would be lying to ourselves if we said that banks don't do anything scummy like that, but at the same time, banks fairly consistently make money. Especially much of the larger and even mid-cap banks, they very consistently make money in almost all economic circumstances. Now, obviously, we've had huge issues with them before, back in 2008, but that does also open up a whole can of worms with, well, why was the government helping and encouraging subprime loans? And while banks might not be that sexy, especially compared to many of the huge tech stocks out there, if you're taking a more conservative approach but you want to beat the market, my two favorite bank stocks might be a good choice for you. The ones I'm particularly fond of are US Bank as well as Ally Bank. In terms of size, they are not as large as something like Bank of America. US Bank is sitting at $67 billion, and Ally sits at $11.6 billion. And again, to reiterate, if you're looking for extreme growth, banks are typically not the best way to approach this, but because they're fairly stable and often a good hold, they're pretty good for filling in a lot of a portfolio, especially if you feel that it's maybe too aggressive. And we can make use of their stability and options in order to squeeze out a bit more value without actually increasing that much risk. If we take a look at Ally Bank's earnings, we see that they have missed the mark in the past, but overwhelmingly tend to have positive earnings per share, with some fairly strong surprises. And we see the same thing with US Bank, but they've been more consistent with turning a strong profit that does beat estimates despite the rough economic times. And that's one of the things that does make people stop and pause about banks, and the reason we saw such a huge drop. Banks tend to make most of their money off giving out loans, things like that. And with historically low interest rates combined with the fear that many people are going to be defaulting or unable to pay their loans because of the high unemployment rate and other complications, there was concerns that banks would see pretty aggressive losses, that they would have to take on a lot of debt, and that things would be pretty horrific for them. And we see even big-time bank backers like Berkshire Hathaway did reduce their position in a lot of US banks, although it still does make up a very healthy amount of their portfolio. And one of the reasons I'm very fond of US Bank, at least, is they're actually very conservative on who they lend to. If any of you have tried to get into the credit card churning game, you've probably seen something like this, where there's a huge list of conditions about getting approved for US Bank if you're a churner. Now, this is an older article, and some of these things don't really apply anymore, like SageStream, credit reports, things like that. But US Bank, especially on their credit cards, are fairly conservative. They really try to minimize risk. And that's one of the reasons I thought their massive drop was kind of unreasonable. They were still a profitable company. Their debt position was really not that horrific, but they were trading at around $60, and if we want to go on the average a little farther back in the upper 40, 50 range, all the way down to $32. And they were keeping that 42-cent dividend. They had that pretty consistently during all of that. And we saw some spikes, but we also did see that huge shift in the market. It happened fairly recently, where a lot of tech stocks dropped and banks started to go up again. That's just sector rotation. There were a lot of articles that came out even farther back, but as we got better and better news about the progress of the current vaccines, the market looked up. They thought we would be returning to normal within a decent amount of time. And there was rebalancing. Obviously, these big tech companies are well poised to be strong in the future, and I don't think that they're going to be declining at all. But people being fearful of the traditional solid investments and dumping more money into companies that can make money while everyone's at home was pretty massive. And when it flipped the other way, we did see some sector rotation. Ally is a stronger example of this, although admittedly they were trading around $32 to begin with, so they're almost back at where they were, sort of on this average end. Although I think a lot of Ally's strengths relate to other things they've done. They are pretty well detailed. They don't just offer regular banking and loan services. Back in 2016, Ally actually purchased TradeKing, which was a very popular online brokerage. And Ally, for a couple years now, has had their own trading platform because of that, Ally Invest. I'd say it's quite a good platform. It's fairly compelling, especially if you're an Ally Bank customer, because you can take money from any of your Ally Bank accounts and just toss it in and out with ease. There's no waiting a couple days or anything. The money is basically instantly there. I know there's other brokerages that will give you credit, but a lot of times they don't let you do things like buy options or make other plays with that. So it's a pretty compelling tool if you're in the Ally Bank ecosystem, even if it's not your primary brokerage. And Ally Bank is obviously incredibly popular. It's a really fantastic online bank that really pioneered the idea of an online bank. There had been a lot before, but Ally was one of the first ones to really get big and go mainstream with a heavy focus on it. And they've developed a pretty nice ecosystem with a fairly robust setup and collection of different tools, like trading, loans, CDs, things like that. US Bank is definitely more on the traditional side of banking, which is one of the big reasons I think it hasn't recovered as much as Ally Bank, simply because it's going to rely a lot more on its physical branches being opened, on everything sort of returning back to normal. And I mentioned earlier on in this video about the strategies I like to use with banks to extract a lot more value out of them. So let me just get to that. I'm going to be talking about options contracts. If you're unfamiliar with options contracts, I have a video introducing the whole concept and going through all the basics about them. I'll have that linked in the description below as well as in the title card of this video. Now, continuing forward, I'm assuming you know something about options. And what I'm going to be talking about are cash-secured puts. Cash-secured puts are a pretty effective strategy that I really enjoy for stocks that I don't mind holding. And as mentioned before, bank stocks tend to be very, very stable, which is why they tend to be a good chunk of tons and tons of these large portfolios that try to minimize risk. They tend to have very solid dividends, and they tend to just consistently make profit, even during rough economic situations, which is why I really like dealing with cash-secured puts when it comes to them. Because the way a cash-secured put works is that you sell a put. Now, it's not a naked put because you have the money to buy 100 shares of the stock if it hits the strike price. And if we put in US Bank as our ticker symbol in Options Profit Calculator, a fantastic website, if we're dealing with cash-secured puts for US Bank, the main reason cash-secured puts are nice for bank stocks is because they let you get more return than if you just purchase the stock, generally. Premiums on these can sometimes not be that insane because they're fairly stable assets, but you will almost always get more money dealing with options plays than you will just purchasing securities. Now, if we go through an example where we select US Bank and we select an option, let's go with the 18th of December. We want a put that will make us a decent amount of money. Now, depending on how bullish you are on the stock, you could do something slightly out of the money. And in fact, that's what I generally do, is I do something just slightly out of the money. So maybe select a 140. And if we calculate, we see that at the end of this, we will make $140. However, if our strike price is hit, then the put will be exercised and we'll be forced to buy 100 shares at $45 a share. So that's $4,500. One of the reasons I really like Ally Bank and US Bank is because of their low share price. I can easily do this and put the capital aside because 100 shares of them is not particularly expensive. And theoretically, you are putting a lot of capital at risk. The stock could go to zero. But as I mentioned before, banks tend to be incredibly stable, and a lot of these big, huge ETFs and companies, they tend to contain a lot of banks. And that's the beauty of a stock, is that you can hold a stock. If it gets executed and it's a little lower, you can just hold on to it until it goes up. And that sort of plays into the whole idea of spinning the wheel. If you're holding a stock, you can sell covered calls on that stock and be collecting premium consistently for that, as well as dividends. And because we decided to use a cash secured put instead of a limit order, our cost basis for the stock actually goes down. We're making $140 regardless. So even if we're paying an overpriced amount for the stock, we still could be making money. Essentially, you just want to subtract 140, the premium, from the amount that you're going to be paying for 100 shares, $4,500. So your effective price per share actually goes down. So if we do $45 for US Bank, that's $4,500. And in around 2 weeks, we are making $140. Now there's 52 weeks in a year. Let's say practically you can sell on 40 of those weeks. I'm trying to be conservative here because you won't always want to sell a cash secured put, and it might not always be an ideal week to sell. Plus, there are holidays. And let's be more conservative with our numbers as well. Let's do $110, let's say you can get every 2 weeks. Now, if we say there's 40 practical selling weeks, we're selling 2-week options, and we're making around $130. Let's say $130 rather than $140. That's $2,600, or around a 57.78% return. That's pretty fantastic when you consider the standard that we use is the S&P 500, which nets an annual 10% return. Now, if we go to Ally, it's actually even better, because we're getting $157 for 2 weeks, about. If we go to our conservative numbers again, 40 selling weeks, so that would be 20 if we're doing 2-week options. Sometimes you can get a little more with 1-week options, but I want to be conservative. If we're making $130 every 2 weeks, and let's say we have 40 selling weeks, that's $130 times 20, which is $2,600, which would be an over 90% return each year when you consider the capital we have on hold. If you're using a margin account, you can still utilize some of that capital, so it's not entirely restrained. But then you deal with margin, and it's not entirely a cash secured put anymore, since you would have to liquidate some of your positions in order to buy, which you might not want to do. But that is a massive return. If you play this correctly, you're effectively doubling the amount of money in your account, almost. You can imagine if you start out with $3,100 in your account and you consistently sell these, you consistently get good premiums, then yeah, you could almost double your money in a year. Now again, you're introducing more risk, but the main reason I focus on banks for this strategy is because I find them to be incredibly consistent, and they're not particularly stocks that I'm worried about when it comes to holding them. Now, if you actually get assigned, depending on your cost basis, you could just sell it traditionally and break even or even make money. Or you could simply sell a covered call on that stock. Since you have 100 shares, you can sell a call on it without any risk because worst case scenario, it just gets exercised at the strike price. Which is why if you're going to be doing cash secured puts, I encourage you to do it on stable assets that you don't mind holding. US and Ally Bank have solid dividends, I'm not super concerned about them in the future. I think they're going to putz along pretty well, especially as things get back to normal. This has been a very successful strategy for me, and I see in the future as things get closer and closer to normal, a lot of banks are sort of going to inch back to the price they were trading at before. A lot of them are making money consistently without too much issue. Despite the crazy economic situation and the interest rates, they've been dealing with it fairly well. You do want to be careful about some banks. Some have pretty ridiculous debt standings, but in general, it's a fairly consistent asset that I'm not super concerned about holding. I would not mind holding these stocks at all. I just realize they're not crazy growth companies. And selling these cash secured puts has made me a good amount of money. I sell them barely in the money, and the stock tends to just go up and I make money. If I get assigned, I sell covered calls, some get exercised, and I continue to make money. And it's pretty comfortable. That's the reason I really like these two banks. Again, their share prices are pretty reasonable. Most people trading can easily sell cash secured puts on them, and you don't need a ton of options trading experience in order to get approved for level 1 and 2 options trading. 3 and above is where it tends to get a little more complicated because you could be putting yourself at a lot of risk. Now, obviously, you can put yourself at risk, especially if you're selling cash secured puts on incredibly volatile and questionable assets. But banks like US Bank and Ally are the ones that I particularly like for that. I'm definitely not selling cash secured puts on penny stocks and things like that. If you want to jump into the stock market and get started trading, Webull is a fantastic brokerage option. If you sign up using the referral link in the description below, you'll receive 4 free stocks. 2 of them will be valued between $2.50 to $250, and the other 2, as part of the deposit bonus, will be valued between $800 and $1,600. That's $2,100 to $3,700 just for signing up. Again, the link is in the description below, and happy trading.